Just a few weeks, that's all it took for more than 300,000 South Korean investors to see their financial future disappear. Not because of a war, not because of a recession, and not because a major company went bankrupt. The trigger was something the world had spent the last 2 years celebrating: artificial intelligence. For months, South Korea looked unstoppable. Samsung kept climbing. SK Hynix became one of the hottest AI stocks on the planet. Millions of ordinary people believed they had found the investment opportunity of a generation. Some borrowed against their salaries. Others took out personal loans. Many poured nearly everything they had into just 2 companies. Then, almost overnight, the momentum reversed. Trading was halted. Forced liquidations swept through the market. Life savings vanished before many investors even had time to react. At first glance, this looks like a uniquely Korean story. But once you follow the money, the trail quickly leaves Seoul. It leads to Silicon Valley, to Microsoft's AI spending, to Amazon's data centers, to Google's infrastructure race, and to a global market built on one assumption: that AI spending will keep growing year after year. Today, we're going to trace how South Korea became the first country to feel the pressure, why 2 companies ended up carrying an entire stock market, and why what happened in Seoul may matter far more to Wall Street than most people realize. If you looked at the Korean stock market just a month before the crash, nothing seemed unusual. In fact, it looked almost perfect. The Kospi had become one of the best-performing major stock indexes in the world. Samsung's valuation exploded. SK Hynix gained even faster. Every headline seemed to reinforce the same belief. AI wasn't just another technology boom. It was the beginning of an entirely new industrial revolution. Money flooded into semiconductor companies. Institutional investors joined first. Retail investors followed. Eventually, millions of ordinary Koreans began treating the stock market as their only realistic chance to build wealth. That might sound irrational, but inside South Korea, it made perfect sense. Housing prices had climbed far beyond what many young workers could afford. Wages struggled to keep pace. Saving money no longer felt enough. Owning a home became a distant goal. Investing suddenly looked like the only remaining shortcut. Then came leverage. Banks offered loans. Brokerages offered margin. Leveraged ETFs promised even bigger gains. Every new record convinced people the risk was worth taking. And every successful trade attracted another wave of new investors. At its peak, the entire market became increasingly dependent on only 2 companies: Samsung, SK Hynix. When those 2 stocks moved higher, the whole country felt richer. Few people stopped to ask what would happen if they ever moved in the opposite direction. Because after months of uninterrupted gains, very few believed that day would actually arrive. They were about to find out. Here's what made South Korea different. Most major stock markets spread their weight across hundreds of companies. The United States has Apple, Microsoft, Amazon, Nvidia, Meta, and hundreds more contributing to the S&P 500. South Korea looked very different. On paper, the Kospi contained hundreds of listed companies. In reality, one trade dominated almost everything: Samsung and SK Hynix. Together, they represented more than half of the entire market. That concentration created an unusual situation. Buying a Korean index fund wasn't really betting on the Korean economy. It was largely a bet that these 2 companies would keep climbing. So why did everyone become obsessed with them? Because neither company was selling smartphones. Neither company was selling laptops. Wall Street wanted something far more valuable: memory. Every modern AI model consumes enormous amounts of it. Training a large language model isn't just about having powerful GPUs. Those processors need a constant flow of data. And that data has to be stored, transferred, and accessed at incredible speed. That's exactly where Samsung and SK Hynix built their advantage. Every announcement from Microsoft, every new AI model from OpenAI, every expansion by Amazon or Meta translated into one simple expectation: more AI, more servers, more memory chips, more revenue. The logic appeared almost impossible to argue against. As long as AI spending kept rising, these companies should keep making more money, and if that happened, their stock prices should keep moving in only one direction: higher. That belief became the foundation beneath the entire market. The problem: foundations are rarely noticed until they begin to crack. Bubbles rarely burst because everyone suddenly changes their mind. Most of the time, they begin with something much smaller: a disappointing earnings report, a weaker forecast, or simply the fear that tomorrow might not look as good as today. That's exactly what happened here. Investors in the United States started paying closer attention to one company, Micron. Unlike Samsung or SK Hynix, Micron sits much closer to Wall Street. Its earnings became an early indicator for the entire AI supply chain. If demand for memory was slowing, Micron would probably see it first. No one needed terrible numbers, even cautious guidance was enough. The reaction came immediately. Chip stocks in America softened, risk appetite faded, global funds started reducing exposure. That shift might have looked insignificant in New York. It didn't stay insignificant for long, because every dollar leaving AI stocks in the United States echoed through markets thousands of kilometers away, especially in South Korea, where almost everything depended on the same trade. A normal market correction usually follows a simple pattern. Someone decides to sell, someone else decides to buy. Eventually, prices stabilize. This time, there was almost nobody making a decision. The selling came from machines. Here's why. Millions of Korean investors weren't buying stocks with cash. They were buying them with borrowed money. As long as prices kept rising, nobody cared. The loans looked manageable. The profits looked real. But margin loans come with one condition: your collateral has to remain valuable. Once the value falls below a certain level, your broker doesn't ask for permission. It simply starts selling. Automatically. That's what a margin call really is. Not a warning, a countdown. If fresh cash doesn't arrive in time, the position disappears. One account after another, then another. Every forced sale pushed prices even lower. Lower prices triggered even more margin calls. Those margin calls created even more selling. The cycle fed itself. By that point, the market no longer needed panic. The system had learned how to panic on its own. This is where the story stops being only about South Korea, because the ingredients behind the crash aren't unique. They exist somewhere else. The United States. America's stock market is much larger, far more diversified, and backed by the biggest companies on Earth. But one similarity keeps showing up: concentration. Today, a small group of technology companies accounts for an unusually large share of the entire market. NVIDIA supplies the chips, Microsoft builds the infrastructure, Amazon expands its cloud business. Google and Meta continue pouring billions into AI. Each company has a different role, yet they all depend on the same expectation: that AI investment will continue delivering future growth. As long as that assumption holds, the cycle keeps moving. Big tech spends more, chip companies earn more, investors bid prices higher. Higher valuations make even larger investments look reasonable. It's a feedback loop, not very different from the one Korea experienced. Of course, the United States is not South Korea. Its economy is broader, its capital markets are deeper. That doesn't eliminate risk, it simply changes its scale. History has shown something interesting. Markets rarely collapse because everyone suddenly loses confidence on the same day. Confidence fades gradually. Then one event speeds everything up. Sometimes it's a company, sometimes it's an industry, sometimes it's a single earnings call. No one knows what that moment will look like this time, but investors around the world are watching for it. South Korea may recover. AI spending may continue for years. None of us knows how this story ends, but one lesson is already becoming clear. Technology doesn't create bubbles. People do. Debt makes them bigger. Confidence keeps them alive. And once that confidence begins to fade, markets can move much faster than anyone expects. Sometimes the first warning arrives quietly. The rest of the world usually notices only after it's too late.